Investors looking for a steady stream of income often turn to dividend stocks as a reliable option. These are stocks that pay out a portion of their profits to shareholders on a regular basis. While not all companies pay dividends, those that do can offer investors a number of advantages. Dividend stocks can provide a consistent source of passive income, which is particularly appealing in times of economic uncertainty. Additionally, dividend payments can help offset losses in the stock's value, providing a buffer against market volatility. What dividend-paying stocks are you monitoring? I'll demonstrate the top 7 dividend stocks for investors in this video. I'll then demonstrate what to look for in dividend investments and the respective analyst price estimates, including one with a 9.7% yield. But before we move on, hit the like button and subscribe to the channel. Don't forget to click the notification bell so you'll be the first to know when we have new video uploads. Now let's begin. Stag has 450 warehouse and industrial properties totaling 91 million square feet spread across 38 states. Office and retail properties have been severely impacted by the pandemic, but the warehouse sector has been thriving. Although the growth of e-commerce and online shopping has harmed the demand for retail space, the requirement for storage space for all those online orders has caused a surge in warehouse demand. In addition to a 3.5% dividend yield, shares of Stag returned 60% last year. While the company has been aggressively reinvesting in new properties, there is a chance that dividend growth will pick up. I'll concede that dividend growth hasn't been all that fantastic, at just 1% a year. AGNC invests $84 billion in securities backed by agencies, the majority of which make up its investment portfolio. This is how mortgage rates operate. Rather than owning the homes itself like other REITs do, they borrow money at short-term rates and utilize that money to invest in long-term mortgages as a mortgage investor. Since AGNC is more akin to a financial institution, you should focus on its book value per share. Rates are still very low compared to historical averages. Therefore, the book value has stayed around 40 cents per share over the past 3 quarters because the company doesn't generate much money on its loans. This indicates that shares are fairly valued at $14.50 per share, which is significantly less than book value. The good news is that the net interest spread, or the gap between mortgage interest rates and short-term borrowing rates, increased in 2020 and is predicted to continue to increase. 225 investors are monitoring ticker ET, one of my favorite energy companies, and I'm not the only one. This stock has approximately 2,000 views. As one of the biggest master limited partnerships, Energy Transfer is the owner of the terminals where oil and natural gas are stored, as well as the pipelines that transport them. Although having a market cap of $26 billion, it is safer than other MLPs because of the size of its portfolio. The dividend for ET was recently increased to 70 cents a share, a 15% increase from the previous payout and one of the best dividend yields. Energy costs will remain high over the coming years, but businesses won't be investing as much in new assets or exploration. They're keeping an eye on the long-term reduction in demand for oil and gas, so they won't be spending as much on new assets. For energy equities, this will result in a lot of cash flow and greater dividends. For example, Energy Transfer spent $5.5 billion on developing pipelines and other assets in 2017, but it only plans to invest $1.6 billion on capital spending this year. This has allowed its earnings to grow from $7.3 billion 5 years ago to as much as $13 billion this year. Shares of ET have increased along with oil prices and the dividend hike, but experts still predict this one rising up by 20 to 11.55 cents per share over the next year. When the stock price goes up, it signifies that the corporation is keeping enough of the profits to reinvest in the business and balance the cash return to shareholders with potential capital gains from real estate. With over 2,800 views and 530 people following it, ticker O is by far the most popular real estate stock. It's also one of the most popular dividend stocks. Realty Income has been in business for 50 years and owns almost 6,000 properties in 49 states, Puerto Rico, and the United Kingdom. Although 83% of rental revenue comes from retail businesses, which are increasingly affected by e-commerce, I'm okay with this one because it's spread among different sorts of properties. AbbVie is the greatest firm in its sector for immunology medications, but it also has a solid pipeline in oncology and eye care. Most drug pipelines are easy to read on a timeline, but AbbVie's is not. 32 indications are being tested in Phase 3 by the business, and Rinvoq and Skyrizi revenues alone are anticipated to reach $15 billion by 2025. AbbVie's large purchase of Allergan offered them a lot more goods and increased leadership in oncology, immunology, and eye care. In fact, 2 of its oncology medications are breaking sales records. The stock boasts a 4.2% dividend yield and over the past 5 years has increased its payout by an unheard of 18% annually. This is one of the top large-cap drug stocks due to the 32% increase in shares over the past year. With only a 2.5% increase to the average target price of $138 per share, analysts anticipate that the return on shares will slow down over the course of the upcoming year. Nevertheless, I believe you can still receive a consistent income and many years of returns. More than 3,500 investors looked at shares of Citigroup, symbol C, over the past year, and 260 continue to monitor the stock. One of the stocks in our Bowtie Nation portfolio that performed the best last year was Citigroup. Since we introduced it to the portfolio, it has increased by 49%. Therefore, we're holding on to it in anticipation of further gains in 2022. With a yield of just 3.2%, it is not the highest-yielding dividend company on the list, but it has a respectable yield and has grown its dividend by an impressive 10% annually over the past 3 years. Banks are among my favorite companies this year, as everyone in the nation is aware. The demand for consumer loans has finally increased after 2 years of customers having plenty of cash and reducing their credit spending. When you combine that with rising interest rates, it's a wonderful moment to buy. At 7 times its earnings, it is extremely inexpensive. So if consumer lending resumes and interest rates rise, the shares may easily reach the average analyst objective of $78.61 per share, which is more than 22% higher than their current value. More than 6,700 people have viewed shares of the ticker symbol T, and roughly 1,000 investors are keeping an eye on this stock. Overall, dividend stocks can be an attractive option for investors seeking stability and long-term growth. Have you considered adding any of these dividend stocks to your investment portfolio? Tell us what you think in the comments section below. And that's it for this video. Don't forget to like, share, and click the notification bell for future uploads. Thanks for watching and see you in the next video.